Welcome to the Pretty Good Policy for Crypto podcast, where we have in-depth discussions on cryptocurrency policy and regulation. My name is Paul Brigner, and I'm head of U.S. policy and strategic advocacy for the Electric Coin Company. We believe in fostering a respectful and inclusive environment for our discussions. And while we believe in the need for private and confidential financial transactions in crypto to promote economic freedom, our guests may have differing views. Through these thought-provoking and at times challenging conversations, we aim to deepen our understanding of complex policy and regulatory issues and work towards the development of pretty good policy for the cryptocurrency world. This podcast is for educational purposes only and is not legal or financial advice. My remarks and those of our guests may not reflect the views of our organizations. We hope you enjoy the podcast. Thanks for tuning in. We have a very special episode for you today. We have a little bit different format. We have two guests and we have a co-host. As you can see here, we have my friend, Professor J.W. Verret, here as my co-host. So I'm going to interview and introduce our guests as well as J.W. a little bit. He is a professor of law at the Antonin Scalia School of Law at George Mason University. He specializes in blockchain, securities, and corporate law. He has an active practice as of counsel at Lawrence Law, LLC, and he is an expert witness for Veritas Analytics. Also a certified public accountant. In addition to all of that, one of the favorite things about him, from my perspective, is that he is an ardent defender of privacy, and he is on the board of the Zcash Foundation. So, as he would say, we are Zcash brothers.
We're Zcash brothers.
This is, for me, a very special opportunity to interview these guests in particular. I rarely come across something in crypto that feels entirely new to me. And I've been working in crypto quite a while now, a number of years, and looking into DYDX and all of the ecosystem that they've created has just amazed me, because it's not something that I can do. I cannot use DYDX legally in the US, so it hasn't been on my radar. I suspect it's not been on too many people's radar who are in the US, but it's hugely important in the industry, and we're going to talk all about that. We have Antonio Giuliano, the founder and CEO of DYDX Trading. He's an ex-Coinbase and ex-Uber engineer. He has a Princeton CS background. We also have Rashan Colbert. Rashan is head of policy for DYDX. He spent 7 years in the U.S. Senate and on the campaign trail working for Senator Cory Booker from New Jersey. He performed a variety of roles, including leading the work on technology and telecommunications issues. On a personal level, Rashan has been obsessed with crypto since 2016. He even launched, for a short time, his own crypto startup. So very interesting background for someone working in policy to be so in tune and experienced with crypto. So as we said, Antonio founded DYDX. This was back in 2017, and he has since led the effort to build it into the world's leading decentralized exchange for advanced trading of crypto assets. He has a world-class team with top backers and advisors. I won't name them all, but it is the top of the top names in the industry. And the DYDX mission is to democratize access to financial opportunity. And that is a great mission. As you might be aware, Electric Coin Company's mission is to empower economic freedom. So I feel like there's a lot in common with what we are trying to accomplish. So with that, I think a good way to open this discussion is to talk about why you're here. I know we all know there's a lot happening in policy, but you had, I'm sure, a very particular agenda going to the Hill. Can you tell us a little bit about that and what you've accomplished since you've been here?
Yeah, absolutely. And appreciate that great intro. Maybe just to give my own quick intro on DYDX as well before answering the question. So we are DYDX. We are the world's second largest decentralized exchange in terms of trading volume after Uniswap. We trade about $1 billion a day is traded on DYDX. We, like you mentioned, are focused on advanced financial products and most notably derivatives. I think one thing that's really important to understand about the crypto industry is that the bulk of trading already happens in derivatives. So about 75% or so of the entire trading volume in the space happens in derivatives. And this is on places like Binance, places like DYDX. And as you mentioned, basically all of these platforms are not available to the US right now because there's effectively no path to get licensed, as a centralized exchange. If you're like a Binance or something, Coinbase tried for a while to get a derivatives platform for crypto licensed in the US. They eventually gave up, and now they're launching one internationally. And I think the other thing to know about DYDX, which may be obvious, is that we are a decentralized exchange, which means that we're built on smart contracts. I like to say smart contracts are just a fancy word for programs that run directly on the blockchain. So you can write up these programs, you can make them into whatever you want. You can make an exchange, you could make a futures contract. And then you write this program, you deploy it to the blockchain, and then anybody can just use it directly on the blockchain. So it's really fundamentally different from pretty much all of financial services to date. And that's why people are really excited about it. It's kind of like if you were using Bitcoin, you just go directly to the Bitcoin network to send Bitcoin to your friend. You don't have to go through the company that is Bitcoin, right? The concept just doesn't exactly make sense. And fast forward to today, Ethereum and smart contracts have enabled this new class of financial services that are just code, and people can go directly to the blockchain to use them. We're excited about this, and I think a lot of people in the space are really aligned on the mission for Web3 and especially DeFi more broadly. It's much more transparent, 10x more transparent than anything you could possibly achieve through audits. You can just go on Etherscan, a block explorer right now, and look up the balance sheet of DYDX in 10 seconds. And that's amazing, right? That solves a lot of the problems that we've really seen plague finance throughout history, and especially in crypto more recently with FTX, right? Like if you had a read-only view into exactly where the funds were, something like that never could have happened. So we're excited about what we're building. It's transparent. It's equally accessible to everyone. Like it's not possible for us to kind of play favorites because it's just the technology that lives on the blockchain, and that's equally accessible. So kind of tackling your question in terms of why are we here. So this is my first trip to DC since like middle school. So I'm a little bit new here, but I think it was a really serendipitous time to be here with all of the stuff that's been going on recently. We were fortunate to meet with a number of different offices, mostly in the House, and a little bit in the Senate too. And just our main message so far is one of education. And I think DeFi is so new and still relatively small, even within crypto. I think people maybe don't realize how small it is right now. So it's about 5 to 10% of overall crypto volume is happening on DeFi. So why are people so excited about it? It's because of the promise that it kind of holds for the future. And I think we and some other people in the space do have ideas on how it might be regulated in the future. But I think by far the most important thing that we're focused on right now from a policy perspective is just allowing innovators, namely us and other competitors in the space, to innovate and to not kill DeFi before its promise can be fully realized. So we're big fans of the overall structure of the market structure bill. We met with a lot of these various offices, and I'm sure we can dive more into this on our specific feedback. But I think it's a really good start, and I think it's a really good faith effort to try and begin answering some of these really important questions in crypto. It's kind of interesting. They intentionally, I think for now, left DeFi mostly out of the bill and more just called for a study to kind of understand what DeFi is, first of all, and then second of all, how it should be regulated. So we're big fans of that approach. And we've just mostly been trying to educate people on, first of all, that DeFi even exists, then what it is, and third, why you might be excited about it. And I personally just feel like it's really useful to hear that directly from the builders themselves, which is why I'm personally here. Obviously, Rashawn is doing an awesome job on the policy side, have a really good legal team behind me. But I think it can be really valuable just to hear directly from the people that are literally building this stuff too.
Certainly, and especially when it's something that so few people understand or have experience with. Like I didn't have experience with it either. So Rashawn, tell us a little bit more about your experience here in DC. This had to be really an eye-opening experience for a lot of the people you met with.
Yeah, it was fantastic. So, my job here in DC is, to sort of tell the DYDX story and to help people understand what we're doing, who Antonio is, where, what DeFi is, how DYDX fits within that ecosystem, how DeFi fits within the larger crypto ecosystem. So, breaking down these layers and helping people understand what's really going on. And obviously, just having the founder, who's a CEO, still involved, technical, understands the moving pieces and how policy will affect the piece of technology as we sort of go down that stack is really critical and interesting. Obviously he's a great, asset to have. And so, I can talk all day and there's some things I understand, some things I don't understand, and he's going to be able to talk about to a much deeper level. And I think it's also excellent to have Antonio or other founders and technical people come to town. It's a critical part of this policy conversation that people see, but I think that hasn't necessarily been the biggest part until the last couple of years. People really seeing how important that is. Because it's just important to get that hands-on view of how the technology works, of what's really going on. And so I think, this is a long process that is mainly based on time and relationships. And at the very least, to start the conversation, it's excellent to have Antonio here to be able to get going in with our talks with everybody.
It's a great way to open things up. JW, did you want to jump in at this point and get something out here for us to discuss? Or I've got a bunch of things that we can...
Yeah, sure. I'm here to learn about DYDX. I've got some thoughts about on the regulatory side. The coolest thing about DeFi to me is that it fixes so many of the hobgoblins of financial regulation of intermediated finance. So I really would love to talk about a lot of that. A lot of the inherent structures of what you're building fix problems that legislators tried to fix in 2010, but you've just done it through smart contracts rather than like a weighty regulatory structure. So I'd love to just dig in on all those things, but maybe I'm too early here. I'm jumping toward the thing I like best. I don't know if we want to talk about
I think that's
DYDX
a good
first.
place to start. I mean, I think that's one thing that might surprise a lot of people in government and policy about DeFi is I personally believe it is really aligned with the objectives of government and policymakers and regulators. What do financial regulators care about? They care about our financial system is fair. They care that it's secure. They care that it's, equally accessible to everybody and that it's safe to use, obviously. And there's a lot that you have to do if you're trusting humans or intermediaries to run your financial services for you. And to this point in history, there's been no other option besides that, right? So it's just like we have to live in this world where we're trusting the banks or the clearinghouses or whoever to hold our funds, and we're trusting the people that run those platforms to give fair access to everyone and to, in the more advanced side of the spectrum, make derivative contracts that are liquid and that function the way people expect them to. And the cool thing about DeFi is, all the things that are traditionally done by intermediaries are now done by code. And the way I kind of explain to policy people why I'm so excited about DeFi is if you could have a financial system that's built on intermediaries or one that's built on code that just works, which would you choose? You would probably just pick code, right? We just want something that works. We don't want to have people have the opportunity to mess with it or to take on risks on behalf of others, things like that. So there are a lot of challenges that we still have to solve in DeFi, but that's what gets me excited about it. And there's a ton on the policy side that we could dive into, and happy to go anywhere. But one kind of obvious part, and I touched on this in a little bit in my previous answer, that DeFi does super well is auditability and transparency. Like a huge amount of financial regulation is based around this, right? Like if you give your funds to a bank or to some exchange, you want to make sure that they're actually going to be there when you come back and try to get your money. And we've seen this already be a major problem, obviously, in crypto. And this is not the first time this has happened in finance. But a lot of these centralized exchanges in crypto are effectively porting what exists in traditional finance into crypto. And it's still novel because there's novel types of assets that you can trade. But the mechanism through which people are trading, the mechanism through which exchanges work is the same. And obviously, we saw FTX blow up in the past year because they were just using customer funds to take on leveraged bets or to buy themselves houses in the Bahamas and all this ridiculous stuff, right? And I think the important thing to understand about DeFi is it's literally impossible for that to happen in DeFi. I, Antonio, the CEO, have no more access to these smart contracts than anybody else does. And that's kind of a fundamentally new concept, right? I think another reason to be excited about it, and this is something that the ex-CFTC chair, John Carlo, has been excited about for a while, is it really gives you a good opportunity as a regulator, as a policymaker, to understand the systemic risk across an entire financial sector. Like, in the 2008 financial crisis, the fundamental problem was, the regulator sort of had a view into some of these exchanges, but it was really hard to tell what was going on across the entire space. And therefore, the entire space took on risks that they shouldn't have taken, and nobody saw the systemic risk until it was too late. Well, in DeFi, again, it's transparent, and you can see exactly what the specifications of the derivative contracts are, how much collateral there is, how much leverage is being taken on by the system, and so on and so forth. So there's a lot of different parts of policy around financial regulation, but just as an example, I think auditability is something that DeFi does 10x better than anything you could possibly do with regulated centralized finance.
I'd love to dig a little bit deeper into how your system works, because one of the things I've struggled with DeFi is it's something that people talk a lot about, but when it gets to be something concrete, I feel like I'm missing it. I don't feel like I really understand the concrete details of what's happening. And in preparing for this podcast, I actually did look into a lot of all the details of what's going on with DYDX and looked at your entire history and how you've evolved and the different versions of the system that you've created. And it was really quite shocking to me that, like, when you say it's novel, it's really novel. It's like it's derivative instruments that I was not aware of at all with the perpetual derivative. It's not something that I've ever had any experience with. In a way, it seems even simpler than working with calls and puts and other things that I might do on my broker. And I like that. That's very appealing. It just seems almost like dealing in a spot market type of environment. So that's nice. And then looking into how you are moving this to be fully decentralized, I thought was very interesting too. One of the things that, as a former technologist, that I loved, and also as someone who works at Electric Coin Company, I really like, is that you've done this so far based on what is referred to as ZK rollups. And we're going to go a little bit technical here for our audience. I know some of you are mostly focused on policy, but I think this is very important, that one of the major issues with DeFi and with blockchains and crypto in general for writing applications is scalability. So ZK rollups, and you're in particular using Starkware, a Starkware solution. Electric Coin Company happens to be one of the original investors in Starkware, so I know a little bit about that. That allows for you to do some very special things with scalability, to like make all of this actually work technically on the blockchain, which I think is fascinating. But as I've looked at your history, I've noticed that you're on a path for more and more decentralization. Like, to be able to run an exchange at the kind of scale that you do is really difficult, because it's just the throughput of a system like that is very high. And so far you've just done that really creatively, but you're just on the verge. And we talked about how interesting this timing is for all of policy and regulatory right now, but it's also a very interesting time for DYDX, and that you are literally transitioning within the next few weeks, I believe, you can tell me more, to what you refer to as V4, like a new version that is going to be even more decentralized than the last, like really fully decentralized, essentially. And I think we have to talk about that a little bit, because it's such a big deal, I think, for you and what you've been doing lately. It's got to be something that has taken all of your focus.
Yeah. Well, that's a great prompt. I think the biggest thing that I try to do with DYDX is explain what the heck we're doing to people, because we're kind of at the intersection of two things that people don't know a lot about: derivatives and DeFi, right? And it's like the number of people that understand both of those things is almost nobody. So let's kind of break it down into the three different parts that you mentioned. I think the first is the financial side. So what is a perpetual? Like, why are they big in crypto? Then you touched on the technology side and then the decentralization side as well. So maybe I'll just start with the financial aspect first, and we can kind of talk about what are perpetuals, why are people so excited about them in crypto, and so on and so forth. I actually think the perpetual contract is really novel and is a good example of the types of things that crypto enables. I think the most core thing that DeFi and crypto enables is finance to just move so much faster in terms of experimentation than you can do in traditional finance. But in DeFi, we've really built up from the ground, from nothing, this entire suite of financial tools. There's lending platforms, there's exchanges, there's effectively clearing houses, there's derivative contracts, all these things. And they've been built in just a couple short years. So zooming in on the perpetual contract. So the first thing to know about the perpetual contract is it's by far the most traded product in crypto. So to give you a sense, traditional futures, dated futures, and options do exist in crypto, but perpetuals trade around 100 times more volume than these kind of traditional derivatives. And the reason for that is because perpetuals are really approachable to the more kind of not totally retail investors, but like sophisticated individual traders as a kind of mechanism to use leverage. And that's the reason why a lot of people are using crypto. And I see a lot of people kind of write crypto off because of that. They're like, oh, it's all just speculation and these random coins, like who cares? And I think that actually is the real first use case that's found super strong product market fit for crypto is trading. And if you want to trade, whether you're a firm or an individual, crypto just lets you do that 10 times better than anything in traditional finance. And I think it's made it much more equal. The assets are, volatile yet transparent. So that makes them interesting for certain classes of traders. And like I was talking about, just the experimentation and pace of innovation for exchanges is so much faster in crypto than it is in traditional finance. So, okay, let me break down what a perpetual contract is, and then I'll kind of stop for questions because we have a lot of complicated stuff to talk about here. A perpetual contract sounds complicated, but it's actually not that complicated. The main key piece to understand is in the name. It's perpetual, meaning that it never expires. So if you're trading an option or you're trading a future or something, it's going to be expiring on some date. And then, once that date comes around, there'll be new versions of that contract, which are priced differently. A perpetual contract never expires. So you can just have a Bitcoin perpetual contract or an Ethereum perpetual contract or any asset that you might want. You could have an Apple perpetual contract for the sake of argument. Right now, the perpetuals are just based on crypto assets themselves, and the Bitcoin and Ethereum perpetual contracts are by far the most popular, but a lot of others are trading as well. And then the way the perpetual contract works as its core mechanism is based on this thing called a funding rate. And again, that sounds complicated. It's not too hard. It's basically like there are some people that are long the contract, meaning they profit when the price goes up. There are some people that are short the contract, meaning they profit when the price goes down. It's zero sum, so there's exactly many units of long as there are units of short. And you are creating this contract that you want to trade at the price of another asset. So we want our Bitcoin perpetual contract to trade at the price of Bitcoin, right? So how do you do that? The answer is with this funding rate. And this funding rate is just a dynamic interest rate that's paid between those who are long the contract and those who are short the contract to incentivize the contract being traded at the price of the underlying. So let's just take an example. Let's say Bitcoin is trading at $20,000 and the Bitcoin perpetual contract on DYDX is trading at, $2,100 or something, $21,000 or something. So the price is too high. So what do you want to do? You want to drive the price back down to the price of Bitcoin. And to do this, you'd have those who are long the contract pay an interest rate to those who are short the contract. And this makes it more attractive to go short, right? So people will sell the contract, the price will go down back to the price of the underlying, and then the funding rate will stabilize again. And that's really it. That's kind of the core mechanism behind a perpetual contract is it never expires. Some people are long, some people are short. And then the shorts pay the longs or the longs pay the short based on how the price of the contract relates to the underlying. So the next logical question you might ask is, hey, what is the point of this? Why don't I just trade Bitcoin? Like, why are we bothering with all of these weird mechanisms to try to create this contract that's just trading at the price of another asset. Like I can just go on Coinbase and buy Bitcoin. That's true. But you can't buy Bitcoin easily with leverage. And you also, it's pretty hard to go short Bitcoin, or at least pretty expensive. So that's the main reason why people are trading these contracts in crypto, is because they have access to leverage. Most users are kind of using relatively safe amounts of leverage, 2 to 5x. You may have seen some of these headline numbers, like BitMEX used to offer 100x leverage, for example. Those are mostly the headline numbers, and in the space, I think there's been kind of a consolidation towards more safety for users and for the platforms themselves, and lower amounts of leverage. On DYDX right now, the maximum amount of leverage you can use is 20x on our most liquid pairs, but still most people choose to trade them with lower amounts of leverage. And these contracts are really popular with two people. The first is trading firms, and there actually are quite a lot of trading firms in crypto these days, kind of two main classes of trading firms. The first is crypto native trading firms. So these are some like Wintermute and a couple others that have started directly in trading crypto, and they only trade crypto more or less. And then the second class of traders, which I think people are just starting to realize are becoming a big player in crypto, is traditional finance and Wall Street, basically. We've done quite a lot of work at DYDX in getting basically all the trading firms that are trading crypto to trade on DYDX and to trade in DeFi for the first time. And that's really hard from a technical perspective. We can get into all the things we had to do to make that possible later, but that's the first core class of customers. The second core segment of customers is sophisticated retail traders. So not your friend that bought their first Bitcoin yesterday. It's really people that are distributed all over the globe, that are relatively sophisticated, that want access to advanced features like leverage, like being able to go short, like stop orders, all these things that normally only trading firms have access to. And that's one of the really cool things. You talked about our mission, which is to democratize access to financial opportunity. And I think the language that we use there is really important, because it's not, access to financial upside or equality even. It's just opportunity, right? And I think that kind of resonates a lot, even from a political perspective here in the US, right? Like we all have access to opportunity. It's really up to you what you make of it. And I think that's true in trading as well. And I think it's really important that we build safe platforms for these people to use that are performant, that are transparent. And that's really what we're trying to do with DYDX. But there's a lot there. Happy to dive into anything that's of interest, but kind of talking about what are perpetual contracts, who are our users, and why are they using DYDX?
You are really good at explaining that, because it really is complicated. But to me, like, one of the things that stands out is from, not a super sophisticated trader, but someone who has been trading, it seems almost easier to me than what I had been dealing with in the past. Mm-hmm. And that is very appealing. And as you note, it's opening up opportunity for people to do what some of the biggest traders and desks in the world are doing. So mm-hmm. I think that is that's an amazing thing to be able to do that and do it in DeFi. And of course, what makes all this work so well and be so compelling, I'm thinking, for all of those traders to do this, is that because it's on DeFi, it's very automated, it's very low fee, it's something that happens very quickly, and as you pointed out, all the other benefits. But I'm guessing if you were to try to do the same thing on a centralized exchange, it would be much more expensive and more difficult to do.
I think that's right. And I think why are people so excited about crypto and specifically DeFi? I touched on kind of the rate of financial innovation is so much faster. I think that's really important. That's probably the biggest thing. There's also a ton of advantages to using DeFi. One really cool thing about DeFi, most of crypto more broadly, is that the settlement happens almost immediately. And that's very different from how traditional finance works. Like, I don't know if people remember when that issue with Robinhood happened, where GameStop was blowing up and Robinhood disabled trading because they weren't able to clear until the next day or two. That type of stuff just fundamentally doesn't exist in DeFi. That when you trade these contracts, the margining happens immediately, the liquidations are real time, and that just allows you to trade, to withdraw immediately. And it's basically a better version of a clearinghouse is what has been built in crypto, and especially with us in DeFi. And that's something that's very new. You know, we can touch on later how that might fit into existing or new policy, but that's kind of one of the fundamental improvements. We talked a lot about the transparency already, so I think that's a really big deal to traders, especially in crypto these days, because people don't trust centralized exchanges, maybe outside of Coinbase, and therefore they would rather hold in custody their own cryptocurrency while they're trading on a product than, you know, give it to FTX or potentially Binance or others like that and trust that it'll be there when they come back. So I think those are probably the biggest things. Maybe it makes sense to talk a little bit more about the technical side because we've a little bit been glossing over.
I think that's very important. Anybody want to ask any other questions about perpetuals before we move on to the little bit of the tech?
Will you indulge one policy question?
Sure.
Because that's
Let's
mine.
do it.
So I think one of the undeveloped stories about DeFi, about you guys, and there are other stars in that story too, on the trading side, on the swap side with Uniswap, on your much more sophisticated perpetual dynamic framework and Curve and Compound, and then on the lending side with Aave, DeFi has been stress tested. Like in the last couple of years, incredibly stress tested. 2008 level for its area stress tested, and it's survived and thrived. To everyone drafting little white papers at FSB, Bank of International Settlements, they have a few DeFi papers out now, and they're kind of like, I don't know, maybe they could be a systemic risk. We should just shoehorn this into the existing regulatory structure. That's probably the right idea, which is such, it's like the opposite of what we should be doing. It's really frustrating to read those papers because eventually they'll bubble up through the bank regulators, through CFTC, through SEC. We already see a little bit of a hint of it in the SEC's threatened ATS rule to basically define everything as an exchange. Including blog posts, I think, potentially, with code on them, right, would be an exchange under that definition. It would be fun to, we don't hear much from Gary Gensler or from Ross Benham about the CFTC's regulatory failure with MF Global. They don't like to talk about that, but it was a deep regulatory failure that could have been fixed by some of the things you're talking about, auditability of code. And also, we haven't talked about yet, but I think is another great feature of what you're doing is decreasing the frictions of liquidation, making it much easier to liquidate. So there's leverage, which is risky, but liquidation is so much more simple and frictionless relative to the existing financial system. So can you tell me a little bit more about if we're trying to just in an elevator pitch, tell your post 2010 Dodd-Frank advocate kind of this is the way we should always do finance. What do you tell them about the benefits this has for financial stability, for limiting systemic risk, and you've already touched on auditability. How do we get them to understand how this fixes some of the hobgoblins of the post-Dodd-Frank environment?
Yeah, well, that's a great point, and I appreciate you bringing that up because DeFi has been stress tested, and I talked about the volatility of the assets that are being traded on these platforms. Like, what if the CME had to deal with assets that were like all 10x more volatile than basically anything that exists in the equities markets for the most part? So that's the kind of stress that DeFi has been under. There is real money that's being traded in DeFi. Right now, I think DYDX has on the order of $300 million or so in open interest, and there's even more on other platforms as well. And there are quite a lot of days in crypto where the volatility is extreme. Probably the biggest one that I can remember is Bitcoin dropped 50 or 60% in a day, and even in a matter of an hour or two, a couple years ago. And that might sound alarming, right? Because you're like, oh, what is happening to the margining on these systems? But this is kind of what I was touching on with the real-time nature of the clearing and the liquidation engines that are made possible by crypto and DeFi really being fundamentally better than anything that exists in traditional finance. And the cool thing about the stress tests is that none of these platforms have actually lost money, or at least the legitimate ones have not lost money because of failure to liquidate, because of extreme price volatility. And I think that's really noteworthy. I can sit here and talk about pie in the sky, like the vision of DeFi all day, but you can actually look at the historic performance of a lot of these products in times of extreme volatility. And it's not limited to derivatives either. Also, the lending platforms in crypto, by far the most popular form of lending in DeFi is over-collateralized lending. So for example, you could put down your $1,000 worth of Ethereum and take, based on the leverage you want, $700 or whatever of a stablecoin. And you can use that to get leverage or, pay your mortgage or whatever you want to do. And if you look at the performance of lending products within crypto, especially over the past year, it's extremely stark, the difference between what happened to all the centralized lending platforms and what happened to the decentralized lending platforms. So you mentioned Compound, Aave, and there are a couple others that are leaders in the decentralized lending space. All of them were completely solvent throughout all of this insane price volatility, even on the day when FTX collapsed and that caused major moves in the crypto markets, tons of uncertainty. Yes, the prices went down and yes, some people got liquidated, but that's how it's supposed to work, right? Like the system itself was stable. And then if you look at all of the centralized products like BlockFi and Celsius and so on and so forth, all is maybe an overstatement, but effectively all of them went bankrupt, right? And they did not work because they were not handling the risk in a transparent and codified way. So I think that's something that is really important about DeFi, is that, yes, it might sound scary, but it just sounds scary because it's new. It's like, and this is again why I keep coming back to the innovation piece, it gives us an opportunity to build things from the ground up in a different way, in a way that can be better. And, there's competition around that. So some people will build things that don't work and, people will decide not to use them. But some people, based on competition, will build things that do work and work much better than traditional finance. And I think that's what excites me about it.
Awesome.
You see why it's fantastic to bring Antonio to DC, right?
Yeah. Come here.
You can explain these ideas so clearly, so succinctly, and answer to any question in a way that it's kind of hard to get, and you can write a lot of papers, but it's great to be able to interact directly with policymakers who, will have a range. Each of them is so different in their understanding that they come to the conversation with. We met with a number of people who, some of them are kind of at the beginning. Some of them are already starting to deal with some of these more complex DeFi problems. I think we're still have a little ways to go before some of our core issues are dealt with in the regulatory environment or the arena, but people need to start thinking in sophisticated ways about it now.
Mm-hmm.
It would be fun to think through 2008. The Treasury Secretary has all the bank CEOs around the room. And the first question is, how bad off is everyone? And everyone was lying about how bad off they were. It would imagine redoing that, except the Treasury Secretary says, hey, we've just done a quick audit on Etherscan, so we know exactly what situation all of you are in. It's just a wholly different environment.
Yeah. And that, I think, is really important for regulators, but it's also really important for the users, too, because they can look on Etherscan, too, and they can be like, oh, actually, Compound is totally solvent, and I'm going to keep using Compound because I can tell that. Like, they can't pull up the balance sheet of a BlockFi or a Celsius or any of these centralized crypto lenders. It's just a concept that doesn't exist. So I think that's one big piece that we keep harping on, but is really important.
Any particular policymakers or people in Congress that you think are really getting DeFi these days? I think we kind of know who those are who are focused on crypto generally, but if you ask me who's the DeFi champion, I'm not sure I know that.
Yeah, I think it's probably not surprising, the folks who are a bit farther down the path, right? I've seen the authors of the recent market structure bill. So the folks both in the House Agriculture, House Financial Services, the chairs of the digital asset subs, like these people are already thinking about these issues. And so I think as they're thinking about them and they realize we're still innovating so quickly, they are right to kind of try and not consider DeFi to the exact extent that they do sort of centralized entities within the market structure discussion draft, right? And pulling them out and looking at that study, I think there's still a few things that we had and that we talked about in our conversations to hopefully make the draft a bit better, but they have a pretty sophisticated understanding of how this stuff is working and where it's starting to fit within the larger ecosystem.
Yeah, and the one thing I'll say that is by far our first really important mission is explaining that DeFi is different than most of the things that are centralized in crypto. And I think it is fundamentally different. It's important for people to realize that, because I think a lot of people come away with this bad taste in their mouth after they hear all the crypto bros saying things like, oh, we're creating a new financial ecosystem for the world, and there's all this new stuff, and it's awesome, and it's transparent. Well, it is, but it has to be in DeFi, like centralized finance. So the Binances, the FTXs, and so on and so forth of the world are just porting the technology and the intermediaries that we had in traditional finance to crypto. And a lot of them have failed, right? And so we see why we have to have regulation. And absolutely, centralized platforms that are based on intermediaries should be regulated. And I think it's just a totally different conversation for DeFi. I'm not going to sit here and say DeFi shouldn't be regulated at all, but we should think about what are the risks for DeFi. I think there are a couple of important pillars that we should start thinking down as we're starting as an entire policy community thinking about how should we regulate DeFi. I think the first one is, what is decentralized? This is actually a pretty hard question to answer. The market structure bill kind of takes a stab at answering this question, but more for token issuers and the tokens themselves. And I think it will make sense as we continue along the course and figuring out some of this policy stuff to think about that for financial services. Like, what is a decentralized exchange? What are the hallmarks? Do the code have to be open source? Does it have to be fully auditable? Like, it shouldn't be controlled by any one or a group of major parties. So like all of these things, you have to check those boxes because there certainly are, and a lot of the detractors from crypto will say things like, oh, well, there's just a bunch of people masquerading as decentralized. And that is absolutely true. And we would love to help solve that problem. But there are also some really noteworthy people, like, I like to think DYDX, obviously, like Uniswap, Compound, Aave, and some others that are building things in the right way, and just enabling consumers to tell the difference between those two, I think, is a really good policy objective. So that's probably the first one. Obviously, we want to make sure these platforms in DeFi are sound as well, because you can build anything in DeFi, and I touched on this before, and you could build something that is decentralized, but maybe it's not financially sound, and obviously that can cause a lot of harm. A really good example of this is what happened with the Terra Luna situation about a year ago, where that was decentralized. It was a stablecoin that was fully decentralized, and it still blew up. Why? Because it was not financially sound. So, I think at least there should be third-party audits. There should be some way for consumers to tell what are the safe platforms versus the unsafe ones. And I think this can both be through audits, it can be through historical performance. It's like, oh, Uniswap has had billions of dollars sitting there in their smart contract for years, and there's never been a problem with that. So, that might give users more confidence in using Uniswap over some of their competitors, and probably the same for DYDX. So I think there are important policy objectives that we should work through for DeFi as well. They're just completely different. And a lot of the existing financial regulation is like, oh, you need to get a quarterly audit. It's like, doesn't make sense. Like, how am I supposed to get a quarterly audit for my smart contracts? Like, the concept is ridiculous. You should just go look at Uniswap. And not only is it ridiculous, it's quite literally impossible to comply because, we don't have any more access, or there's no one entity that's controlling the DYDX platform more than anybody else. So a lot of these things, I think, just require us to start thinking from first principles about how should DeFi be regulated. And, that's a really big open question. We have some thoughts, but I think it's something that will take a while. And again, I'll just reiterate, our biggest policy position is that we should just give DeFi the space to innovate and continue to build and work with policymakers towards a sound regulatory framework in the future, but that's going to take time.
What I think you pointed out is that there are so many different considerations in DeFi. And from my perspective as a former technologist and software developer, I think that policymakers just don't understand the tech, and they've got to understand how it works to know the difference between a Terra Luna and a DYDX. Because if you don't understand the architecture, and if you don't understand all these details of how something's built, you don't really know if it's set up to be solid over the long term. I think it would probably take a few hours to go over all the details I want to get out in this conversation today. But I think it is important just to spend a little bit of time, as we had been on the path earlier, of talking about the architecture and how it works, and then how it's becoming decentralized, because that is just a fascinating story.
Yeah, absolutely. So there's a ton to talk about here, and I will try to break it down as much as I can. But I think it might actually make sense to start all the way at the beginning. Like, what is decentralization? What is a blockchain? Because if you don't understand that, it's a little bit hard to understand, the next point along the path, which is what is DeFi. So a blockchain is decentralized, and that means that no one entity can control it. So if you don't understand that much about the technology, which is totally fair, most people don't, you might ask, how is that possible? And it's possible because a blockchain is run by tons of different computers, basically, all over the world, that all keep the same version of the ledger. So, this is, if you ever hear the term like miners or in proof of stake validators, this is what these people are doing. They're just keeping an entire copy of the ledger meaning all of the information that exists on the blockchain. So that could be like Antonio has 1,000 Ethereum, and Bob has 2 Ethereum, or has this position on DYDX, or whatever the state is. That's exactly what these miners and these validators are storing. And it's really important to differentiate that from something like the cloud, for example. So in the cloud, yes, all of like Amazon and all of the CME, for heck's sake, is running on computers too. So like, why is this different? It's different because those computers are running in the cloud, and there's only one computer. This is sort of a gross oversimplification, but I think is kind of useful, and we can dive more into anything. But there's only one computer that's really running the code behind any centralized platform, like a Google or an Amazon or the CME or the New York Stock Exchange. And that's just fundamentally different than in crypto and in blockchains. There are thousands, potentially even more of these computers that are all running the same version of the software. And the cool thing about that is it's really censorship resistant. And what people mean by that is any one of these computers could go down, could be acting dishonest, could be like saying like, oh no, Antonio has 1 million Ethereum, right? But the way that consensus works is it forces all of these computers that aren't necessarily economically aligned or anything like that to work together to come to, quote, consensus on what exactly the state of the chain is. And you can remove any one of those computers, like you can spin up new computers, and just the way that the blockchain works comes to consensus on who exactly has which money, like who has which positions on DYDX, and that is kind of the technological basis for what is decentralization. So, okay, now we kind of understand that a blockchain is all these computers running all over the world. They can be doing random things, they can go offline, but the system is fault tolerant, meaning that any of these things can happen, but the system keeps going. It's actually really similar to the way the internet works. So there's no company that runs the internet, right? It's sort of a ridiculous concept. Like, how is this possible? Who's running the servers that run the internet? And the answer is everybody. And again, like, the internet is a fault tolerant system. So some switches or some IP routes can go down, but the internet will continue to work. And it's very much the same thing in crypto. So it's a new technology, right? But it's based on a lot of the things that we already have experienced in technology before. And the best way I can kind of explain it at a high level is that the internet is decentralization of information. Now all this information lives on all of these computers all over the world, and it's a really powerful concept, right? You don't have to be the editor of the New York Times anymore to get your information published in, a really high readership way. You can just start a website and nobody can tell you that you can't, right? Like, at least from a technological perspective. And that's a really fundamental thing that enabled all of the proliferation and explosion of these things that people never thought of, at the beginning of the internet. They didn't think of Amazon. They didn't think of, a search engine is going to be super useful, all these things. But just that core concept that information was now decentralized and generated by the users was fundamentally really important. So why are people excited about crypto? And, this term Web3, like, what the heck is that? Why is it appropriate? I like to say that crypto, and specifically blockchains, are decentralization of value. And I use value as sort of a, intentionally abstract term. The obvious use case here was something like money. So something like Bitcoin, like can we create a currency or tokens that represent certain assets? And the fundamental difference is that it's user generated because it's decentralized. Like anybody can start a token. Like it, again, at least from a technological perspective, you can't stop them from doing that. And there's just no way for me to create an asset without doing that. And that's fundamentally what's enabled by this technology. You know, we talk about tokens, but this is really what I'm talking about when I talk about just the pace of financial innovation. This is why. It's because anybody can deploy any piece of software, any piece of, new financial services that they want. And again, at least from a technological perspective, you can't stop them. Like anybody can just put it out there, and that just makes the rate of innovation for these products go so much faster. So that's kind of the main core reason why I'm really excited about crypto and why I think it's fundamentally new. And if you hear people saying things like, oh, it's the new internet and like all these things, that's why people are excited.
Can I go back to decentralization, the pace of decentralization? Bitcoin decentralized pretty quickly. Of course, something as sophisticated as a perpetual platform, what you're building, shouldn't be reasonably expected to decentralize quickly. It's not just going to kind of organically become a thing that everybody does together. One of my favorite follows, and not necessarily because I always agree with him, but I think he's good for the ecosystem, is Chris Bleck, who's kind of the siren song of you're insufficiently decentralized, and he points that eye on lots of different projects, right? Which is, he's not always right, but it's a healthy thing. Sometimes he reminds us that, oh, you think this is safe, but you call it a non-custodial smart contract, but 6 people on a multi-sig could change it and just drain the funds. So in that way, it kind of is custodial. So what would he say? How would he prod you to decentralize faster? What, if he were here, what would he probably say? What would be the response? It's kind of my, yeah.
No, I like Chris Bleck as well. I think he's a little bit of a firebrand sometimes, but his point is valid.
Yeah.
And this is sort of what I was talking about before when I touched on what might potential future regulation for DeFi look like. One of the core pillars is how decentralized are things? Because I think at first glance, it's tempting to think of decentralization as binary, being either things are not decentralized or they are decentralized. But the truth is it's a spectrum. And, you can have things that are obviously centralized, like centralized crypto exchange, and you can have things that are obviously super decentralized, like Bitcoin or Ethereum. So I think what Chris would say, and maybe kind of taking a step back and just painting a little bit of a picture as to our path and kind of our history at DYDX, we have approached decentralization as something that is intentionally progressive. So we've started right now, DYDX operates in sort of a hybrid mode where there are some aspects of the platform that are decentralized, and then there are some aspects of the platform that intentionally are centralized. So let's go through what those are. So obviously, I've been talking a lot about smart contracts. Smart contracts basically that hold all the customer funds for DYDX, that validate every trade, that do the margining, for example. And this is where literally the rules lie. So it's like, oh, you can't take on a position that's 50x leveraged because the smart contract is going to enforce that you have a maximum leverage that's lower than that, for example. So that's where we get all of the nice properties of non-custodial trading. Our users can interact with the platform just holding their own coins in their own wallet. It's where you get a lot of the transparency benefits. So you can just, like I was talking about a lot, go and look at smart contracts, go and look at how much funds are there, like what is the systemic risk, what's the leverage taken out on the platform, so on and so forth. And for DYDX right now, it's a little technical, but I think it's worth diving in, kind of talking about the centralized piece right now for DYDX.
Yeah, and how are the smart contracts amendable? Who controls the admin key?
Yeah, good question. So for the smart contracts today, there's no multi-sig behind them. Multi-sig, kind of just defining that term for those who don't know a little bit, is called a, quote, multi-signature wallet. And this basically means that there's some wallet that a bunch of people control together. So it's like you have to have a number of them come and decide to do anything particular with this wallet. So if you talk about multi-sig wallets being controllers potentially of smart contracts, that definitely is a thing that you can do and a way that you can build smart contracts. But on the spectrum of decentralization, it's less decentralized, right? Because now you have this multi-sig, it could be 5 people, it could be 10, could be more, but there's some number of people where if you convince them to do the thing, then that thing can be done. For the smart contracts right now, they are mutable. Mutable is kind of a computer science term that means they are changeable, so they can be upgraded. But they are only mutable or changeable by governance. So governance is another really big topic that you might hear thrown around in crypto. And this is what a lot of the tokens are used for as one of their primary use cases. So there does exist the DYDX token, for example, and only through a DYDX token governance vote can these smart contracts be modified. And you might ask, well, like, why do you need to modify the smart contract? It's for things like adding markets. So if there's like a new trading pair that people want to add, if there's some security issue in the system, if there's some upgrade that we want to make, like potentially a new, order type or modifying the risk parameters or something like that. And somebody has to do that. But, if we go back to the DYDX mission, that's why we're also very intentional about the language that we use there. We're democratizing access to financial opportunity, right? And that's exactly what governance is doing. It's like, for the first time in history, we can create these financial services that are quite literally controlled by their users. It's like, if you're running a financial platform, if one exists, like, who would you rather control it? Some random executives or the users? It's like obviously better, right? And yes, there's a lot of nuances around that, and it's hard to make it work. And this stuff is really new and still just, experimental in terms of decentralized governance, but it's working. And one of the cool things that I touched on before is that at DYDX, we've gotten a lot of the trading firms to be really active users of DYDX. And it's cool because you actually see them playing a really big role in governance. So they're out there on the governance forums, putting out proposals, communicating and debating with each other, like what should be done with the platform? Are there improvements that we should make? Should we tweak certain parameters? Should we add new markets? And that's a really good class of user. Obviously, the individuals are able to hold tokens as well. They're able to participate, and then you just have a token vote. And, it's democracy, basically. It's like, exchange of the people by the people and for the people. Like, that's what we're building here. It's like so aligned with American values that I think it just makes a lot of sense. And once you can kind of get people past the fear of something new and something, potentially dangerous, it is potentially dangerous, right? Like, this is people's money. Like, that's really important that we safeguard that and we build these really transparent, secure systems for them to be able to trade on. And we should do that in the right way. But if just the opportunity of being able to potentially do that much better with a more inclusive financial system, one that's safer, one that transcends borders in a way that the traditional financial systems don't, I think we should at least allow innovators the opportunity to kind of pursue that goal.
And you were just getting to one of the key differences that I wanted our listeners to understand from this podcast is, in comparison to some other DeFi projects, let's take Uniswap, for example, you have this other part that is not decentralized yet, that you're working to decentralize. So that is what has enabled you so far to run an order book model for a system, which is pretty remarkable that you've been able to do that, and you're moving towards decentralization. And that's not something that like a Uniswap, for example, does, right?
Yeah.
So it's something that I think most people would not necessarily understand, but it's a really important point that people should know about what you're doing that others really haven't done before.
That's a great point. So let's again maybe start at the beginning, just defining what an order book is and what an automated market maker, or if you hear the term AMM, is. So let's start with an AMM. So these have become probably the most popular type of trading model within decentralized finance, at least for exchanges. And kind of the progenitor of this is Uniswap. There are a bunch of others now, like Curve, and so on and so forth. But an automated market maker effectively puts an algorithm that market makes based on this algorithm in a smart contract. So it could be like, oh, if people are buying this much Ethereum, then make the price go up this much, and I'll sell it to you for like this particular price. And that's all based on an algorithm, a formula, basically, that's literally written into the smart contract. This has trade-offs. There are some really good positives to this, and there are some negatives as well. One really cool positive of this is that it enables anybody to act as a market maker. Literally all you have to do to be a market maker on Uniswap is deposit, and then the smart contract will start market making with your money. And traditionally, the market making activity is extremely specialized, right? It's like only the best Wall Street funds can really do this. So this is, again, if we talk about like democratizing access to financial opportunity, Uniswap is not my company, but there are a lot of other really cool things happening in DeFi that are approaching that goal. It's like, we're taking this super sophisticated financial activity and making it available to everybody. And that's just like a really big theme of DeFi in general. So that's automated market makers.
To be Goldman Sachs.
You get to be Goldman Sachs, exactly.
I mean, that's
yeah, pretty cool. But there are trade-offs to all these approaches, right? And I talked about DYDX as being focused on advanced financial products and derivatives, right? And I talked about our users. They are a lot of these trading firms. They are these sophisticated traders. And generally, they're a lot more advanced than traders of a Uniswap or spot trading. Spot is just a fancy word for regular old buying and selling. And therefore, our liquidity model is different. So we are based on order books. Order books is the way that normal exchanges work, basically. Like this is the way that the New York Stock Exchange, the CME, all of them work, is there's an order book. Order book is just kind of a fancy word for a bunch of people offering to sell a given asset at a given price and a bunch of people offering to buy an asset at a given price. And the main people that are providing this liquidity are market makers. And that's true on DYDX as well. It just lets you, compared to automated market makers, provide a lot more liquidity and then provide more advanced types of trading, which is what our users want. So one of the problems, kind of diving into the technical side in blockchains that probably everybody has heard of at this point, is that blockchains are not scalable. And this is true for the most part. And if you kind of go all the way back to my explanation, like 101, what are blockchains, you can kind of quickly understand why. And the reason for this is because everybody that's running an Ethereum validator is copying this information. So you're copying it thousands and thousands of times, right? And therefore the scalability is pretty low. That's a little bit of a gross generalization too, but I think it makes sense. And therefore, it's really hard to build these systems like order books from a technological perspective. Ethereum, to kind of give you a sense of scale, can process on the order of like 10 to 20 transactions per second. On an order book, you usually require thousands of transactions per second, because what is happening? It's these market makers, and specifically their trading bots, so it's software, not humans, interacting with this platform, placing and canceling orders all the time. It's like, okay, I'm a market maker, the price of Ethereum is 1,000, so I'll offer to sell it to you for 1,001. And then they're like, oh shit, the price just moved to 1,001. Now I'm going to cancel that order and I'm going to like offer to sell it to you for 1,002, and constantly doing new things as the price is moving. And we at DYDX, talking about the centralized piece of DYDX right now is this order book and this matching engine system. And the reason that we did that is because it's just fundamentally impossible to build anything close to performance enough for an order book based on current crypto technology. So right now, the way DYDX works is people go to our website, they'll place an order. I want to buy Ethereum for $2,000. That'll get routed to our order book and our matching engine. If that matches with another user, so if we find the other user that's willing to sell them Ethereum for $2,000, then that'll be routed to smart contracts to actually execute the clearing. But one of the things that really excites me about crypto and blockchain technology is that it is improving, and specifically it's improving exponentially. And exponential growth is a really powerful thing. Like if you talk about anything in tech, you're talking about exponential growth. That's where all of the big technology winners come from. And that's absolutely the case in crypto. Specifically, new blockchains are able to process orders of magnitudes higher transaction throughput. Now instead of the 10 to 20 transactions per second that you have on Ethereum, maybe you could have 100 or 1,000 or 10,000 transactions per second on some new platform. There's so much to talk about here. It's a little hard for me to go into anything, but just to kind of give you a lay of the land from a technology perspective as to what's happening in blockchains right now, there are kind of three classes, I would say, of blockchain technologies. So the first is regular old, quote, layer one chains. Layer one is just like the bottom layer. It's like the first thing that exists, and you need this to kind of come to consensus. So this is things like Bitcoin, Ethereum. There are some newer layer ones that you might see out there as well, but Ethereum is by far the biggest. Then the other thing that people are really excited about is layer twos. So layer twos, sort of as the name implies, are built on top of a layer one. So you could have one that rolls back up to Ethereum. So the biggest ones here, you mentioned Starkware, which is the leader in ZK rollups. We're working with them right now. So the current platform for DYDX operates on this layer 2. We are actually pretty much by far the first major product to be built on a layer 2. We've been built on a layer 2 for 2 years now, which maybe doesn't sound like a long time, but crypto moves so fast. It's actually quite a long time in crypto. Fast forward to today, DYDX is by far the biggest application in the world in terms of value transfer on a layer 2. And it's using some really cool technology, right? Like we talk about Zcash. We talk a lot about the privacy implications of zero knowledge proofs. But if those proofs can actually be used for scalability as well, and it's very complicated, so I won't go too much into it. But there is just a ton of new cryptography and technology that's enabling all this stuff and enabling it to be orders of magnitudes better. So we talk about layer 2s. There's a couple other ones like Optimism, if you hear that name, or Arbitrum. These are all things that roll back up to an Ethereum layer 1. And you'd use them because they're way more scalable. They're like on the order of 10 to 100 times more scalable than Ethereum. And the thing that we're building right now at DYDX, which is extremely ambitious, nobody has done it before, is we are going to fully decentralize DYDX in the very near future. And specifically, the part that's hard to decentralize is what I've been talking about this whole time, is the order book and the matching system, because it requires really high throughput. And we are building what we're calling a decentralized but off-chain order book. So that means that the order book and the matching is run by the validators of what will be the DYDX chain itself. And then they eventually come to consensus on which particular order is matched on this chain. So what we're building for DYDX v4 is we're building our own blockchain based on a technology called Cosmos. Cosmos, if you hear that term, is actually not a blockchain. It's just a technology that enables anybody, to build their own blockchain in a relatively easier way. So that's what we're building right now. Again, this was sort of a spicy move for us when we decided to do this in the space, because like I mentioned, we were the early ones on layer 2s. And just fast forward to today, people are starting to get really excited about layer 2s. And then we're about to move off of a layer 2 to build our own chain. So people were pretty surprised by this, but I think it just is reflective of that fact that I was really excited about, which is that the technology is continuing to improve exponentially. So maybe just as an interesting business tidbit, I feel like it's really important for us as a platform to continue to evolve with that technology. And it's actually really hard to build a product like this, where you build this product and then you completely throw it out in the favor of some new product, right? That's just like not how tech companies usually work. But for us, I think it's really important, because if we don't do that, then somebody else will build on this new technology and could potentially build a platform that's 10x, 100x better than ours. And we have to do this from a product perspective, keep building on these new technologies, because they give real order of magnitude type benefits to our users that are real. So like when DYDX was based on Ethereum layer 1 a couple of years ago, our users were having to pay really high fees. To give you a sense of this, you might have to pay a fee of $50 for every trade that you make on DYDX, which is ridiculous, right? Like, who wants to use an exchange where you have to pay $50 to make a single trade? Nonsense. So, we felt like we had to solve this problem. We're built on Starkware now, and now you would pay on the order of a cent or less to, for gas fees on a trade on the platform. And that's a really important fundamental unlock. And that enabled us to grow orders of magnitudes bigger. So hopefully that was useful, just kind of giving a lay of the land. There's tons of jargon in crypto. But from a tech perspective, I think the most important things to realize is that not all blockchain technology is created equal. And specifically, the space is making a lot of progress from an infrastructure perspective, just enabling apps like DYDX to build much better products. And that's kind of what I talk about, where why do we not need to solve a lot of the policy problems today? I'd love if we did that, but really DeFi is pretty small still. And it's small because it's hard to build these things, and the technology is still improving. And though we've built something that we're really excited about, and that is an awesome product, there are still drawbacks to it. It's still, in some ways more complicated to use. The latency is a little bit higher than a centralized exchange, so on and so forth. But these are the things that the great technologists working in the space are solving, and we just have to give them time to do that.
That is exactly what I was hoping to get from you and to hear from you, is like how you're moving so fast and how you're just developing an entirely new system and letting the other stuff go over time and reinventing yourself. It's an incredible way to think about business, and I think it's very smart on your part. I think you're doing an amazing job. Just yesterday, I think it was the SEC chairman, Gary Gensler, was on CNBC. He said, "We don't need more digital currency, as we already have digital currency. It's now called the US dollar. It's called the euro, or it's called the yen. They're all digital right now. We already have digital investments." So I think what you just described shows how wrong he is in saying that, because the technology is changing exponentially.
Mm-hmm.
The ability to make systems like you're doing, that ability is changing exponentially. It shows to me the risks of saying, okay, we have a digital dollar already, or let's just create a central bank digital currency. These things cannot possibly evolve at the rate of what you're developing.
Mm-hmm.
It is something just completely different. So that's what I wanted our audience to understand, is just how fast you're moving and how you're just doing things that literally no one has ever done, but you're doing it in a way that does have the potential to create a new financial ecosystem.
And a safer, from a financial stability perspective, safer system, I think. If you're a central bank regulator or derivatives regulator and you're being honest, there's some attributes of what you're building that are not only cutting edge, but also safer.
Mm-hmm.
You just have to admit that.
Absolutely.
And what's amazing is I think we've only really scratched the surface. Like, there's so many more details that we could go into about what's happening in the DYDX ecosystem and with the governance model that you have, that I think is also industry leading, to be able to have different DAOs and sub-DAOs that focus on different things.
Mm-hmm.
It's mind-boggling. It's like going down, as I kind of suggested earlier, it's going into the crypto rabbit hole a few levels deeper than I thought existed. And I encourage everyone to take a look, because this is really, really important. And I think from a policy perspective, people need to respect it. They need to understand what you've described. And like you said, this space needs some time, when we need to understand it before we jump to making policy and putting this stuff into law.
And I think that's absolutely true. I think one thing that's worth noting is that most people, almost all of them, that really take the time to learn what crypto is and do dive down that rabbit hole, come out with a lot of excitement, right? They're like excited about, like, oh, I get it. It's like we can build these programs that for the first time run on a blockchain and they're not controlled by anybody. That's fundamentally new. That's fundamentally different. I don't know exactly like who's doing this or what the possibilities are here, but it's exciting. And I think that bears noting, because, you know, people are scared of new technologies and there are potential negative implications, but definitely like the people that take the time to really dive in and understand it are the ones that are the biggest champions of it as well. I think most of the opponents of crypto don't know about crypto that well. There are some that know about it and are still opponents, like can't ever convince everybody. But I think if people just take the time to understand what crypto is and why these, you know, random nerds are excited about it, it will kind of make a lot of sense to them as to why we're excited about it and what we're building here.
Unfortunately, I know you have to catch a train, and there's just so much more I would like to be able to cover. Again, I think we've just scratched the surface, but I do have to wrap up. I have to let you go. Any final remarks for Sean before I've been taking a lot of Antonio's time here. I feel sorry about that, because my initial idea was just to do the podcast with you, and you said, "Oh, you're going to bring Antonio?" I said, "Okay, great."
No, obviously, you know, like I was saying at the beginning of the conversation, I think he's a fantastic communicator, both for DYDX, obviously, for DeFi and for crypto. And so I'm happy to always have Antonio speak and people listen. Because there's a lot of ideas that, as we discuss here, I think one of the core things for everyone to leave with is that the innovation is happening rapidly. And things are different today than they were yesterday. Things will be different tomorrow than they are today. And so people need to understand that. And I think that's why really I am at DYDX. And I think I believe deeply in crypto and blockchains as a general purpose technology. And I think that all types of things are possible. All types of things will be possible tomorrow. But as Antonio suggested earlier, one of the first killer applications of this technology is trading. And so things are moving so quickly at places like DYDX. And so I think it's a place where we're going to see this technology really start to take off. So I'm happy to be here.
Awesome.
Very cool.
Well, I want to thank you all. I would just want to conclude this with a vision that I have for the future. And that is a future where DYDX makes this transition to become fully decentralized. You're working on Cosmos, and then perhaps Zcash moves to proof of stake, working on Cosmos as well. People have the financial privacy and economic freedom with Zcash that they need, and then they can move it into a decentralized exchange seamlessly, because it would be relatively easy to move that Zcash into DYDX and then have a very different, transparent environment to do your trading, but still have financial privacy. That is a vision I very much hope will come true in the near future. And sadly, I have to leave this conversation a little bit disappointed because I can't use DYDX. Very, very, very frustrating to me.
Yeah.
Me too.
Absolutely. Well, if I can say one more thing too, I think just a lot of people are so excited about crypto because of the scope of what we're doing and because things are changing so quickly. It's like, how many technologies exist that could potentially change the biggest and most important market in the world in finance? It's just one, right? It's just like only crypto. And what we're doing is really novel. It's still like relatively small in terms of the overall financial ecosystem, but I think it's just the potential that gets people really excited about it. And that's why I'm personally really excited about it. It's like, what is our % chance of success actually, making DYDX into the biggest derivatives trading platform in the world? Probably like pretty small. It's like maybe like 10 to 20%. But I honestly believe that. I honestly believe it is like 10 to 20%. And if it's not us, it'll probably be somebody else that outcompetes us or whatever. But this is the way that finance is moving. And I said this before, but I think it's a good point to end on. If you could choose to have your financial system built on code or humans, which would you pick? You would pick code. It's obvious. Like, just to me, it makes so much sense that DeFi will be something that's really important in the financial industry in the future. When? I don't know. That's always the biggest question in technology. Is it going to be next year? No. Is it going to be like 5 years? Probably not. Maybe 10 to 20 years from now before DeFi really starts playing a huge role. But just being able and kind of having the privilege to lay the groundwork for what I believe will be a massive change in the world, right? Like, what if the entire world had a financial system that was equally accessible to everyone, that didn't discriminate, that was transparent, that was secure? Yes, there's so much stuff that we have to figure out before we get there, but just that vision, I think, is worth pushing for.
Is it fair to say artificial intelligence would probably prefer
Maybe, yeah.
smart contract-based
Absolutely,
finance
that
than
too.
central intermediaries, right?
Yeah.
No question.
Thank you all so much. It's been such a pleasure. I am so excited about watching what you do in the future. I will be watching closely from now on, and I hope all of our audience really enjoyed this, because this has been an extremely special discussion.
Thanks for having us. We really appreciate it.
Thank you, guys.